Welcome back, everybody. We got Jim Black in his amazing background. Dude, you should do all your videos on this background.
You like it, huh? All right, we
I
got
like
we
it a
got some
lot.
we got some bourbon. We got whatever you want. This is actually a interactive background,
That's funny.
so they should make those. That's a great idea. Interactive backgrounds.
Interactive. Yeah, dude, you grab it, it's augmented reality.
Exactly,
That would be
exactly.
crazy. Um,
That would be cool.
all right, let's get into this one. Jim, I have a question for you after you show me what you got here, where we're going, opportunities. I also want to talk about how Wall Street is jumping in and allowing people that maybe wouldn't normally be able to buy in the current market and sharing equity. So I want to get to that. But first, where are we at? Like, where are we going with real estate?
Right now, things are tight. We know people as rates go higher and there's uncertainty, there's an anchoring effect that becomes more and more and more powerful. People are not moving unless they really need to. And I know agents are starting to wonder if this is the norm. One of our good friends, Tony Hansen, had a great post this morning talking about this will be your best year if you're disciplined. And again, there is opportunity. It's just basically how do you focus on the highest and best use of your time to get those results. So you just have to do a better job of filtering and weeding out a lot of the noise to make sure that you're spending your time with those clients or prospects that really are going to do something.
Hmm.
That's my 2 cents on the matter.
I like that. I mean, just to push back on Tony, wouldn't it be your best year anyway if you just sit down and focus it? I'm just
Yeah,
saying.
exactly. Yeah,
Like,
totally,
come
for
on.
sure.
All
But
right.
so
I think there is a massive amounts of opportunity in transition. Here's where I think the opportunity is. You're being distracted, not you or I, but in general, right? You're being distracted by AI and you're being distracted by politics, right? And both are real. Like AI will affect our industry. It's already showing. And politics does affect our industry. We're watching it happen too. But in that transition, in the noise, I think that's where we can bring a lot of the calm. We can bring the opportunities to those clients that need to transact. Because, yeah, we're down 3.98 million homes sold year over year, but that's also almost 4 million homes being sold, dude. Like, homes are still being sold. We just have to do a better job of targeting those people, meaning showing up consistently and attracting those people that actually want to move and transact. How are you doing that?
I'm using niches. I'm going after niches. As they say, the riches are in the niches. So I'm using specific products and specific strategies to stay focused on the segments of people that have life events. For example, buy before you sell or renovation financing prior to listing. Those things are needs that people need to understand and learn about. They don't want to hear that rates are 6% or 8% or I can close in 6 days. They want to hear how the product and services I can provide stand out in the crowd and can create value for them in any market conditions. So I'm doing a lot of education right now on buy before you sell, renovation loans, and equity share type of products. Because those equity share products do help create more leverage for the right type of buyer. And I know we're going to talk about that right now, but
Yeah, well, we'll
those
jump
wealth
into it.
products, yeah, those wealth products have evolved and they actually are pretty decent if you think about some of the ways to use them. So if I
Tell
could
me,
share my,
yeah,
okay.
tell me about it because here's how I see it without, because I remember maybe 6, 7, 8 months ago, you explained it to me and it was with your buddy. I forgot who it was. But the first thing I thought of was it seemed predatory, but the way that you phrased it may be different because you're saying, hey, the right people, right? Because I also feel like the other type of loans in some cases are also predatory. The ones that are sometimes pushed on an older generation, right? And if it's done wrong, it's predatory 100%. So this one, explain it to me so you can change my mind more.
You got it, buddy. So what we have here is it's called Steadworth. And what Steadworth is, if you can see my screens, hopefully, if they come up in two
Almost.
seconds.
There it is.
There we go. Okay, so you can see my whole screen perfectly.
Got
Okay,
it.
so what Steadworth offers, for example, in this example, we have a $500,000 purchase price. What well share programs do is help you with the down payment to then look at maybe other ways to leverage that other money you would have used into other things. So with
Hmm.
Steadworth, they have a 5, 10, 7, 10, 15, 5, and 7, 5 plan. What does that mean? That means that they'll give you 5%, or sorry, a 5-year plan with 10% down a 7-year plan with 10% down, 15% down in 5 years, or 15% down in 7 years.
Okay.
What you want to think about are some of the variables here. We just use a 6% as the mortgage rate. PMI is the thing that we're avoiding by using products like this, because when you put down less than 20%, PMI factors are real.
Yep.
So in this example here, we have a 5-year term with a 10% down payment, which means this product is giving $50,000 towards a down payment, and the borrower is bringing in the different $50,000.
Okay.
The well share appreciation is the key. You mentioned Wall Street earlier. Your home well share percentage, you get 65% of the appreciation on your house.
Okay.
Steadworth in this example gets 35%. And that's at that 5-year, 7-year mark, whichever term you choose. Well, how does this benefit me as a consumer?
Okay.
How it benefits you as a consumer, on average, your loan would have been $450. Now it's $400. Comparing apples to apples, the payment is going lower for the principal and interest. You avoid private mortgage insurance. In this example, it's $281. So your overall savings is $581.03 a month using this product. Over time, it is a lot. And over time, your appreciation and savings is all built out here. So for example, if we took a 4% appreciation over that term of the loan, your home would have appreciated $108,000. You get $7,000. Steadworth gets paid back their amount, and they get $27,782. So you've created a total value. Yeah, you've created a total value of $98,000 less the interest amount, right? It would have been 108, but now it's 98. So it's a really viable way of looking at alternative ways to leverage your money.
All right.
Pretty
Question
powerful stuff. Yes.
When you on the left-hand side where you're like the 5-10 plan, the 7-10 plan,
Yes.
5-15, 7-15. What happens if we get to the 7-year, right? Or let's just stick with the 5. What happens? I'm on year 5 and now my home hasn't gone up much in equity. What happens? Do I still have to pay this, or do I still have to exit?
You'd refinance. So let's say there's no appreciation here. I'm going to adjust the variables down. Let's say that's 0 or 1%. We're using 1%, I guess, is the worst case. 1.1, whatever.
Yep.
So in this example, if your house only went up 1% every year, that future value would be $528. Your remaining mortgage balance would have gone down. Remember, you're paying mortgage, your principal and interest payment. So your first mortgage balance continues to go lower. You'll have equity of $155,000. Steadworth would have got $61,000. So you can refinance at that point in time if you want to and get a new mortgage. That new mortgage would be for $422,000 and allow you to have that all paid off for you. So it gives you flexibility to think about, do I make the payments today, or do I defer those payments and maybe pay off credit card debt? Maybe I can now invest in my 401k, my 529 college savings plan. Maybe I need furniture for the house I'm moving into. Maybe I have other expenses that I need to worry about in the short run. It's a really powerful thing. Yeah.
So you have to refinance no matter what, 5 years out on that.
Sell or refinance. Yeah. Sell or refinance. Those are the ideas. So you want to be.
Help me through this. If we're at 6% rate, mortgage rate, and who knows, 5 year, I have no idea what the hell happens. If the rate's lower or the same, great. But if it's higher, then I'm still forced to refi at that time?
You are forced to refinance the second part of this loan. So you have two choices. Yeah. First and foremost, your principal's gone down, right? So that's a good thing. So even if rates go a little higher, you might end up with the same payment. Number two, you can refinance just the second loan if you wanted to also. Let's say rates were at 8%. You wouldn't want to touch your first mortgage. You could just do a second loan, either a fixed loan or a HELOC for the balance. So you have flexibility there.
Okay. So my assumption on this is this type of loan is not going to work on a market that's not appreciating, because the company won't invest in a market that, like, if Florida, Tampa right now, you'd be like, can't go in there, right?
Here's the cool part about Steadworth. Steadworth they don't get paid any appreciation if there is no appreciation. They have an insurance product built in with Lloyd's of London that guarantees from foreclosures and short sales. So if things get crazy, the borrower can basically, if something happens to them and they cannot afford their payment, they have flexibility to know all their choices in the state that they are in. Every state's different around short sale foreclosure rules, but there's protections in place. So Steadworth has built this out with Lloyd's of London as the insured financial tool and product, which is the first of its kind. So very powerful stuff there.
I like it, man. I like it.
Yeah.
I think, well, what we're watching is I think it's Maine. There was an article about Maine and this type of specific loan a couple of days ago in the Wall Street Journal. And they were saying that there's going to be a lot more regulation around there, a lot more disclosures so that they're protecting the consumer because some consumers
100,
won't know
yep,
what's going on.
100%.
What do you
Yep.
think about that?
I like it. I love more disclosure. I love more protections for consumers. Every state I'm in, this product is considered a lender product. I love that because it makes them have to be at the highest standards. They have to have regulations in place. They have to follow the
Got it.
laws. So I love it. There are a lot of fly-by-night companies out there, but this one in particular has done all the vetting. And what's kind of fun is it's really truly financial flexibility, lower monthly
It is.
costs, and a partnership. If things don't work out, that Steadworth could be losing money also in that regard. And there are tons of calculators. There are tons of things around here. You can also search for homes on this stuff. You can actually look at a home and look on this product and see what that payment would be with the down payment assistance. Or I should say, home appreciation share. Pretty cool
What's
stuff.
this? What's this type of loan called?
This is called a wealth share or equity share appreciation loan.
Equity
We
share
even have
appreciation.
some employers, we even have some employers that are subsidizing this to help them bring in talent to their company. For example, a lot of doctors
Oh, I
that,
remember you showing this. Like, there was
yeah,
the hospital you guys were doing, right?
exactly. Hospital systems use this, large employers are starting to use
Yeah.
this as a way to attract clients, creating a fringe benefit, to be able to offer something. Hey, we'll help you with affordability while you're moving here and getting moved in and transitioned in. So it's a very powerful thing.
I like it.
Again, there are tons of resources. We have facts, very important stuff that's important to learn about. Everything from what is wealth, home appreciation share, all this stuff. Very, very cool. Very, very cool stuff that's available. And again, it's just all the other options out there are probably good options also. Do your homework.
Well, I don't know about that. This is good. I love that you're backed up for insurance and foreclosures. I would say this, man. Like anybody looking at this, they probably have to go through a company like the one you just showed me because if it's anything less, I don't know. It's so new. Like we're just barely hearing all about this in the last year, 2 years, right? It's been around
Yeah.
lately, but I think what we're going to start seeing is we're going to also start seeing the opposite of you guys, meaning, oh shit, we can make a lot of money on this. Let's go, right? Skipping steps, disclosures, not really caring about people. So I'd say if anybody's looking to do something, go with a company like, is it Steadworth?
Yeah, Steadworth, you can put it in, and maybe we'll put it in the chat. But again, do your
Steadworth.
homework on it all. Just learn the
Yep.
options. And again, our goal is trusted professionals give you the
Yep.
tools to empower you to make the right decision for you and your family. And your
I
goals are
like
different than mine and all that stuff.
Good job, man. I like this.
Appreciate it. Appreciate it very much, my friend.